Hi there, and thanks for tuning in. I'm Brianne Sosha, a Las Vegas-based certified financial planner, also known as the Financial Yogi. And each week I deliver a short financial video meant to be educational, easy to understand, and relevant to your financial life. For a full listing of videos, make sure to check out my YouTube channel and also my website, financial-yogi.com. Today we are going to discuss one way to minimize risk when we invest by differentiating short and long-term investing strategies. Being invested properly is an important component of having a sound financial plan. And part of being invested correctly includes making sure that the amount of risk you take matches your time horizon. For example, let's say that short-term financial goals include goals that you would like to achieve in the next 3 to 5 years. Then this money should be invested in a way that will minimize the risk of losing money in the short run. For most people, it makes sense to fund goals that you want to accomplish in less than 5 years with lower risk investment vehicles. And options that fall into this category include current income sources like your income from work, money markets, savings accounts, certificates of deposit, also known as CDs, or possibly short-term bond funds. Now, money market accounts and savings accounts are places to keep funds that you want to be able to access easily and without worry that the money will fluctuate in value. And money markets do carry some risk, but that risk has historically been very minimal. A CD may offer a higher interest rate for locking your money up for a period of time, usually anywhere from 3 months to 5 years. And a short-term bond fund may offer a better return, but carry some risk that your principal may fluctuate in value. So now let's take a look at longer-term goals, things that you want to happen later, 5 or more years from now. Most people need to save and invest in order to reach these goals, so you're going to need to make some decisions here. And as you know, investments that provide for potential higher rates of return generally also carry higher levels of risk. And it's important that you design your investment portfolio in a way that matches your comfort level with risk. That is, your tolerance for changes in the value of your investments. Because when there's a mismatch, people can make emotional decisions that end up hurting them in the long run. So now let's look at an example of investing for the long term. Let's say funding college for your kids is a goal and it's going to take place in 6 years. You may decide to invest in securities that carry some risk so that you have more growth potential. However, you probably won't want to take as much risk as you would with money invested for your retirement, say 25 years from now. Why? Because you have more time to ride out the volatility and potentially make up for down years that might occur during that 25-year time frame than you would during the 6-year time frame. For most people, longer-term investing means investing in the stock market in some form or fashion in order to maximize earning potential. So make sure you tune in next week because we're going to be taking a look at different ways of investing in the stock market for the long term. And as always, if you need help understanding if your financial accounts are invested correctly for your time horizon, please reach out to me. I'm happy to explain in more detail. Thanks for tuning in, and I'll see you next week.